Okay, let's dive into this explainer. Today, we're looking at something called the Hawkeye secret. We're going to unpack exactly how to read naked charts and, decode the market's hidden language so we can avoid what are known as whale traps. So let's get right into it. So, how many times have you been the prey in a whale trap? Seriously, you know the exact feeling. You're watching the chart, right? Maybe it's Bitcoin. The market is crashing, the momentum looks completely unstoppable, so you enter a short position. You're feeling confident, but then, literally in the blink of an eye, the price just violently swings back up, hunts down your stop loss, kicks you out of the trade, and then it rockets to the moon without you. It's incredibly frustrating, isn't it? It feels almost personal, like the market is just watching your specific screen. Well, that painful scenario isn't a coincidence, and it's for sure not just bad luck. It's actually a whale trap. This is a sudden market reversal that's deliberately designed by market makers to hunt stop losses, like yours, and catch retail traders completely off guard before rocketing in the opposite direction. See, they need your liquidity to fuel their massive positions. You were, unfortunately, simply the prey in their trap. But by understanding the mechanics we're covering today, we can actually start to see these traps way before they spring. Now, what's really interesting about this slide is the stark contrast in psychology and methodology. On one side, you've got the rookie trader. The rookie is basically driven by emotional chaos. They chase runaway candles, panic the absolute second they see red bodies on the chart, and use these noisy lagging indicators. It's kind of overwhelming. But on the flip side, we have the sniper. The sniper methodology is all about reading naked charts with absolute precision. They set ambushes and they just wait patiently for the prey to come to them. It's a completely different game. To really grasp that sniper approach, we've got to look at how the market actually communicates. The market speaks in wicks. We're turning off the RSI, the MACD, all that moving average spaghetti cluttering up your screen. Because while rookie traders just stare at the thick, colored body of a candlestick and let it dictate their emotions, a true sniper looks straight at the wick. The wick is where the real story is being told. We literally need to completely reframe how we see candlesticks from here on out. A wick is not just a thin, insignificant line on a chart, it is a battlefield. When you see a long wick, you are looking at the direct aftermath of a massive, invisible war between buyers and sellers that just took place right there in real time. It's a visual record of aggressive combat, and if you know how to read it, you know exactly who's winning the war. Let's break down the exact anatomy of that battlefield wick. Imagine a long, lower wick. First, sellers push the price down aggressively. I mean, it looks like a total crash. The rookies, they're panicking, mashing that sell button. But then, buyers step in with massive institutional level liquidity. They just absorb all that selling pressure. And finally, the price drop is completely rejected, pushing the candle all the way back up. So the crucial point here is this concept of price rejection. This is the exact chart signal created when that massive buyer liquidity completely overpowers the aggressive sellers, leaving behind a long lower wick. Spotting this specific rejection, especially at a solid predefined support level, well, that's the ultimate Hawkeye signal. It's essentially the market makers showing their hand. And when that perfect setup appears, when you spot that undeniable price rejection at a key level, you have to pull the trigger and go long with zero hesitation. You don't second guess yourself, You don't sit around waiting for 5 different indicators to cross over to give you permission. You've read the naked chart, you've surveyed the battlefield, you see that the buyers won, and you execute with total, unwavering confidence. But before you can execute with that kind of ice-cold confidence, we've got to address the deadliest rookie trap out there, FOMO, or the fear of missing out. This is when you see a crazy, unpredictable price pump, right? Green candles just flying up the screen, and you blindly jump in directly during the pump because you're terrified of missing out on profits. Honestly, it's a massive mistake. Letting emotions hijack your trading plan is exactly how you end up buying the absolute top right before the market dumps. As you can see, a core rule here is that we never chase the fast train. A true sniper never sprints after their target. Actually, scratch that. A sniper doesn't even move. If the price is already running away, let it run. It's gone. Chasing runaway price action is a guaranteed way to get slaughtered by volatility. We stay disciplined, calm, and we wait for the next highly probable setup. And this brilliantly illustrates a zone you should avoid altogether: no man's land. This is the current, totally unpredictable middle ground of a chart, where the price is just hovering without any clear support below it or clear resistance above it. It's basically just noise. If you're entering trades in no man's land, you aren't trading, you're just gambling. You've got no structural advantage and you're essentially serving yourself up on a silver platter to become prey. Instead of getting lost in no man's land, a sniper establishes their hunting grounds. The focus here is on very specific, high-probability areas, clear supply zones, robust demand zones, ironclad support levels, and ironclad resistance levels. You've got to learn to draw these lines on your naked chart. These zones are exactly where major decisions are made by institutional money, so these are the only places you should be looking to set an ambush. So how is this actually executed? It's a procedure called the sniper ambush. Step 1. Identify that the price is in no man's land and wait. Just do nothing. Step 2. Find your supply and demand zones. Step 3, and this is where the magic happens, drop your limit orders. Set your buy limits and sell limits directly at those ironclad levels. Let the market come to you. And step 4, walk away quietly. Take the emotion entirely out of it. If the market goes crazy, it hits your carefully placed ambush, secures your profits automatically, and you're out before the rookies even know what hit them. Everything we've covered today basically boils down to 3 core pillars of the Hawkeye mindset. First, absolute precision in how you read the naked chart. Second, unwavering patience to just sit through no man's land and let the market come to you. And third, strict discipline to trust your limit orders and never give in to FOMO. Consistent trading absolutely isn't about luck. It's about adopting these exact traits. The ultimate takeaway here, stop being liquidity for the market makers. By understanding the hidden language of the charts, identifying price rejection, and knowing how to set a sniper ambush, you're taking back control. You're anticipating the market with absolute clarity and structure, rather than just reacting out of fear and greed. So, I want to leave you with a final thought. Which coin or Forex pair has cost you the most lately? We've all got that one chart that seems to constantly hunt our stop losses. Think about the asset that's been trapping you. Apply these Hawkeye principles to its naked chart and see if you can spot the battlefields you might have missed before. Thank you so much for joining me for this explainer. Keep your radar on, stay